On today's hot sheet, I'm discussing Goldman Sachs economic and housing forecasts, weekly mortgage applications, and a decline in asking rents. Today is Wednesday, December 13th, 2023. I'm Byron Lazine, and the hot sheet starts now. Welcome back to the hot sheet. Certainly let me know in the live chat which market you're tuning in live from today. If you haven't done so already, make sure you get into BAMX. We've been releasing our show notes this week for the first time ever. We're going to continue to do that to BAMX members. Use code HOT to get 10% off of BAMX so you can get access to the show notes every single day from the hot sheet, as well as our daily downloads from the hot sheet, all of our courses, live streams, and our community. Use code HOT to get 10% off. Okay, Goldman Sachs has a forecast. It's forecast season all month, it seems. We continue to get these outlooks for 2024 and beyond, and Goldman Sachs has thrown theirs in the ring. Theirs extends all the way through 2007, and the headline is Goldman Sachs is hating on real estate up until 2027. All right, why are they hating on real estate? Let me give you, I think, the most meaningful stat that they're projecting out as it relates to housing. And it's much different than some of the other ones that we've seen, and certain, to be frank, some of the ones that I'm rooting for. It has to do with the level of transactions. Okay, so projections from Goldman Sachs on transactions, on sales, estimate existing home sales at 3.83 million in 2024. That's where we're at now on the seasonally adjusted. So they're basically saying the slow time of 2023, what we're experiencing now, is going to extend out through the next 12 months. That's Goldman Sachs projection. They've got 4.24 million in 2025. They've got 4.37 million in 2026. They do not see a meaningful recovery in transactions in unit count until 2027 at 5 million. Now, remember, just a week ago, I believe it was last week, we covered some of Redfin's projections. Listen, I've been hard on Redfin for a lot of different reasons. I'm rooting for this projection. Okay, if you remember last week, Redfin has at quarter four in 2024. So in 12 months, they have existing home sales at a seasonally adjusted annual rate at 4.5 million. Goldman Sachs doesn't see that number, 4.5 million, happening until sometime in 2027. Remember, they had 4.37 million for all of 2026. That's still below the 4.5 million. So if you're rooting for one of these projections to be right, be rooting for this one. Remember, I said last week that this particular chart, that home sales will rise into this projection from Redfin, from their economics team, is maybe the single, biggest deal to me in all the projections I've seen. This is the one I want, that I'm rooting for the most, more than an impact on interest rates or anything else. If you get transactions, if you get movement, that's going to be certainly very helpful for the real estate professional. There's two sides to every transaction. So this would equal here in quarter four of 24, according to Redfin, 9 million opportunities. But Goldman Sachs, we want to look at all these projections. We want to see where everybody sits, and kind of understand what worst case scenario is versus maybe a more bullish scenario. And so we've got to respect every forecast. Obviously, there's a lot that can happen between now and then to see what comes true and what doesn't. As we always do, I'll drop all the tables into BAMX daily downloads, and you can see here all the way to the right the existing home sales projections from Goldman Sachs. You also see their home price, and they're using Case-Shiller's projections as a 0.6% increase in 2024, followed by 3.8% in 25, 4.9% in 26, and 4.9% in 27. When we're going to finally hit 5 million in existing home sales. They have new home sales increasing each of every year in from 24 to 27, from 723K to 858K in 2027. But for, people say, hey, home sales are dropping. Goldman Sachs is saying there's going to be, fewer home sales next year than there was this year in 2023, and they start to attach that to price. Understanding what Goldman Sachs full projection is going to help you speak more intelligently about how it can impact price. Yeah, Goldman Sachs has transactions moving down while others like Redfin has transactions moving up this year. But Goldman Sachs, while they have transaction sales moving down over the next 4 years, they have prices moving up. And I'll show you this chart here. This is where Goldman Sachs forecast model, thank you to Resi Club for putting this chart together, where Goldman Sachs forecast model expects U.S. home prices to go through 2027. They have a seasonal drop, which you can see right here, which we are going to go through over the next couple of months, according to Goldman Sachs, before they have a 4-year acceleration on home prices up and to the right of the chart. So Goldman Sachs, while they are maybe the most bearish I've seen on total transactions over the next 4 years, they expect U.S. home prices to certainly soar once we get to the end of 2024, almost 4% in 25, 5% in 26, and another 5% in 2027. Remember, when we're talking about home value appreciation, how it builds wealth, this is a compounding number. This compounds year over year over year. And this is how so many people have generated massive wealth through real estate. So Goldman Sachs, while they're not bullish on the home sales, the total transactions, they are very bullish on home prices. Okay. So certainly Goldman Sachs would probably be in the camp of, an extension of really low inventory, of an inventory crisis, squeezing the affordability and seeing that these prices will actually go up even as transactions go down. So important to, there's a lot of these rooting, right? We even saw that survey where people were rooting for a real estate crash, something to happen in real estate. And so when they hear transactions down or transactions are crashing, or there's a real estate recession it's due to this lowering transactions, they point, oh, there it is. There's the first signal. Here's the shoe to drop. And well, wait a minute. The same folks that are projecting that these transactions are going to significantly go down are also saying home prices are going to significantly go up. So you can't have it both ways. If you're with Goldman Sachs on the sales going down, if that's something that you're rooting for, or that you're pointing towards as some type of signal, then you got to take into context their other projection. And we as real estate professionals should be able to navigate through these conversations to help educate people to make the right decision. Because if they're waiting for, a transaction drop to correlate to a price drop, well, we haven't seen that in the last year and a half. As we've seen interest rates go up and transactions go down, we've seen prices set a new all-time high, which would support Goldman Sachs projection going out. And we also don't see that, in the future, because we don't have this rush of inventory that is apparent without some type of other catastrophe happening in the economy. What does Goldman Sachs think about the economy? Core economic forecast for 2024 through 2027. They've got real GDP up in all 4 years, 2.1%. Next year, followed by 1.9, 1.9, and 2%. So Goldman Sachs, according to their forecast model, the U.S. economy is poised to pull off a soft landing as both unemployment rate stays low and inflation drifts closer to the Fed's 2% target. In fact, Janet Yellen, just interviewed yesterday, she says, I believe I'm paraphrasing a little bit here, I don't have the direct quote in front of me. She says that she believes there is no reason. I can actually pull up the quote. Instead of me paraphrasing, I hate doing that. Let me just get her quote. I know it's bookmarked here. Here it is, Janet Yellen. Here we go. From Nick T's Twitter to your ears. Yellen, inflation is certainly meaningfully coming down, and I see no reason why inflation shouldn't gradually decline to levels that are consistent with the Fed's mandate. I personally don't see any good reason to think that the last mile is going to be especially difficult. Okay, so you're starting to see a lot of prominent, economic people, forecasters, and even government officials now, like Janet Yellen, saying that they believe we will have a soft landing. It's going to be real interesting this afternoon to see what Jerome Powell says. If he uses the word soft landing, if he thinks that's more likely, are we going to avoid a recession? These are all the questions that certainly he'll be asked in the press conference. How he answers them is going to be important to, how the investors and how the markets react. Going back to Goldman Sachs projections, unemployment rate, they basically have it flat, 3.7, where we've been this year for the next 4 years. They don't see unemployment moving at all over the next 4 years. Consumer price index, they have us down to 2.4 next year. This is one of the better ones that I've seen. So CPI inflation at 2.4% for 2024. It means we're going to have a meaningful drop in inflation at some point in the near future. From 3.2 to 2.4, that's significant. Obviously 3.1 as of yesterday. So, this forecast they have the 3.2 in there, which was from October. 2.4 in 25, 2.4 in 26, and 2.3 in 2027. So Goldman Sachs not giving the Fed what they want, the 2.0, but certainly pretty close there and really flat over the next 4 years at a 2.4 level. Now, here's where, here's something to pay attention to on Goldman Sachs. Look at the 10-year Treasury yield. They don't have it going anywhere. In fact, they have it higher than where we sit today. Today, we're back under 4.2 on the 10-year, which is beautiful, right? But they don't see any significant improvement on the 10-year. In fact, Goldman Sachs says the forecast suggests a 10-year Treasury yield of 4.55 in 2024 and 4.5 from 2025 to 2027, possibly keeping mortgage rates elevated for years. They do not see a significant impact on bringing down the 10-year Treasury yield, and unless, obviously, some type of unforeseen circumstances present themselves, which they often do when we're making these projections. Just think back to early 2020. Nobody saw that coming. Goldman, here's some more on the housing, obviously, with the strained transactions. That the 5 million in 2027 is still below 2019, which is 5.34. So this is they're like saying, hey, we're going to be digging ourselves out of a deep hole here on transaction count. Now, their forecast is much more bearish than others, as I mentioned before, such as Fannie Mae and Mortgage Banker Association. I have much more bullish reports, and we just showed you the Redfin one, where their projection is much higher on the transactions. So there you go on Goldman Sachs. There's a bunch of other information in here, including when they believe, and it's all in the show notes. So if you're a BAMX member, you'll get access to all of these, but including when their chief economist believes the Fed will cut. They believe Q3 now in 2024. That's their projection, as opposed to previously Q4. Of course, we saw the CNBC survey, which expects now we will see a mid-year cut. They do not believe we'll have a cut anywhere in the first 6 months, they being Goldman Sachs. We will obviously see what happens, just as we've been seeing what happens to housing demand, home buyer demand, as these mortgage rates drop. This week being the biggest indicator of them all. Mortgage Banker Association has reported that applications increased in the latest MBA weekly survey to 7.4% from 1 week earlier. Now, we've had week over week, as these rates have dropped off of the high of up over 8, we've had week over week increases in mortgage applications, but this is the biggest number yet at 7.4%. It's the biggest number I've seen in quite some time, and it comes just a couple of weeks before all the major holidays. And if you've got holidays happening now, you've got holidays happening the end of the year. This is holiday season here, where many people are kind of like, let's wait till after the holidays. No, you're seeing mortgage applications make their biggest jump in recent memory to 7.4%. Not only that, you also saw the refinance index go up 19% from the previous week, 19% on refinances, which is a huge number. 4 out of 10 loan applications last week were in the refinance category. Okay, so refinance now making a climb back. This tells me, like, why are people refinancing now here when we know the majority of the mortgages are under 5%? Why are people refinancing at 7? This tells me people are sick of waiting. It supports Zillow's projection for 2024, where they say people are just going to get comfortable. These would-be sellers that have been waiting, they're going to get comfortable with their rates are, and they're going to put their house on the market, which would support more transactions, not less, Goldman Sachs. But this tells me that there is a comfort level of, listen, I got to go make a move. I'm sick of waiting. There's going to be rates higher for longer, so I'm going to go ahead and make that move to get some liquidity, whether it's for a business purpose or a personal purpose, or maybe it's, moving into a bigger, whatever the case may be. There's been a limit on liquidity for not only businesses, but the American consumer, certainly over the last 12 months, all year. And one way to get some liquidity is to go refinance and take some of that equity that's been locked away in people's homes. So seeing refinance going up tells me people want the cash. They're getting more comfortable with where the rate is. Here's the quote from Michael Frattitoni, MBA's SVP and chief economist. Mortgage rates dropped last week as incoming data point to a slowing economy, support a pivot by the Federal Reserve to begin cutting rates next year. The 30-year fixed rate declined to 7%, lowest level since July. Borrowers who had seen rates near 8% earlier this fall are now seeing some lenders' quotes rate even below 7%. I'm sure many of you have seen that as well. Refinance picked up in response to this drop in rates, particularly notable increase for FHA and VA refinance applications. That's interesting because usually FHA, VA are going to be, or VA rather, going to be pretty low. Rate purchase volume was running about 18% below last year's pace as prospective homebuyers still challenged by a lack of inventory, even as rates have decreased. Another signal this, provides potentially is that there's going to be a significant pickup in activity, both on the list side, new listing side, and on the, home buyer demand side as early as week 2 in January. If you're seeing this application increase now into the holidays, when do those searches and when do those listings become even more serious? There could be a little bit of a light switch effect like we had in January of last year. I don't know if it'll be as significant. Last year, of course, we hit 5.99 on the Mortgage News Daily 30-year fixed at one point in January, which was a huge catalyst. But could there be, maybe instead of the light switch, maybe it's the pull down, the little pull down string on the lamp. Maybe it's a jolt. Maybe it's a breaking point, an inflection point happening or building up into January. It's just one possibility I think we should take into consideration. I think the Fed, when they finish their meeting today, should take into consideration the fact that rents continue to decline throughout this country, and it's going to happen in a much more significant way as the rest of this inventory gets released into some key markets. The tide turns, Redfin says, for renters as asking rents post the biggest decline in over 3 years. Median U.S. asking rent fell 2% year over year in November. So much different than Zillow was reporting in yesterday's. The biggest decline since 2020 as landlords grapple with rising vacancies due to building boom in recent years, but rents are still rising in the Midwest, partly because of out-of-towners are moving in to get more bang for the buck. You see here on the charts, which should be available on BAMX, that they are median asking rent had this biggest decline in 3 years, but you also see the year-over-year change. And that is reflective also of not only asking rents, but actual rents. This chart on the bottom that just shows throughout the year a straight downward trend on rents is what's happening in both actual and here as reflected in the asking rents. And we know based off of yesterday's CPI report how much the shelter and owner's equivalent rent is making up of inflation. And so with any luck, we'll get some more of a real-time approach from the Fed. Certainly, I'm not counting on that, but that would be something I'd be rooting for. Apartment construction boom is obviously giving more renters to choose from as more of these come online here in Q1 and Q2. It's going to create more competition. You also see now that apartment construction boom starting to slow down significantly as developers realize, wow, we are maybe getting ahead of our skis in some of these markets on inventory for multifamily. Housing units that are 5+ units have been accelerating the last few years, and certainly even before that. You can go back as many as 10 years, built more multifamily in this last 10 years than at any other point going back to the 80s. So multifamily inventory going to be on the rise, and that's going to impact those prices, and it's already impacting vacancies. Rental vacancy rate climbs to 6.6% in the third quarter. Obviously, nowhere like what we saw during the run up to the great financial crisis and the aftermath of the great financial crisis, but certainly on a consistent upward trend all year after having lows in 2021 and 2022, lows that date all the way back preceding the 90s. So we are now getting back up to more normalized vacancy rate, certainly historically speaking. Okay, there's your update on Redfin rents. You can get all those charts and all of the show notes on that inside of BAMX. Okay, so today we've got the Fed meeting wrapping up. We're going to have Jerome Powell speaking a little bit later today, and we'll be watching what the market reactions are to that. What's the 10-year, for example, going to do during the Jerome Powell press conference? There's some good signs here this morning before he even talks that the 10-year is back down under 4.2 at 4.166. Remember, Goldman Sachs believes we're going to be at 4.5 all year next year, which would pop up the, anytime we've seen that, we've seen the 30-year fix closer to 7.5. But right now we're at 4.166. We'll see what the reaction from the 10-year is based off of Jerome Powell's comments. They'll be looking, less at the decision, because the decision's kind of baked in the cake here. They're not going to increase the rate. They're not going to drop the rate today, and more of what he's saying about the future so that they can place their bets accordingly. The 30-year fix yesterday came in at 7.09. So we've been very consistent there. If we don't see a pop on the 10-year today, we should be at or below this number later today on the next reading. We also, for the first time, have a Nick T from Wall Street Journal projection that the Fed could start cutting rates in quarter one. So first time anybody's said this. Nick T, of course, is the Adam Schefter of the Fed. When they want to leak information out, they leak it out to Nick T. I'm not saying that the Fed leaked that information, but in a recent article in Wall Street Journal, he did say that it's possible the Fed could cut as early as quarter one. We'll look for hints and suggestions to support that on today's press conference with Jerome Powell. We here at BAM, we break down tomorrow's show notes are going to be spectacular because you will have every single detail from that hour-plus press conference that's important from Jerome Powell. Every single time that he mentions housing, there will be a timestamp there, so you can go directly to that from the show notes. Of course, we'll break that all down on tomorrow's show as well. So make sure that you are subscribed and hit the bell for that. Tomorrow is the Fed meeting breakdown. And every time he mentions housing, we'll break those comments down specifically only on the hot sheet. Subscribe, hit the bell, and we'll see you back here tomorrow. Until then, toodaloo.